What could be an efficient asset allocation mix only using ETFs for someone who is investing for their long-term goals for a 30-year-old?
The best way for you to build a portfolio is through
40 to 45 other AMCs which launch largely if they focus on active products. Why is that contrast strategy there that you want to launch only passive products?
Again, it's not a contra strategy. Passive products are the ones that will help.
Where do you see passive investment sector going forward in India in the next 10 years?
The industry together is working on is to build a fast.
Today, we have Mr. Vishal Jain, the CEO of Zerodha Fund House with us. Vishal brings more than 20 years of experience dedicated to building ETFs and passive investment products. He was a part of the founding team at Benchmark AMC, where he launched India's first ETF, that is Nifty Bees, back in 2001. In this episode, we'll explore first, the challenges and opportunities in the passive investment landscape. Second, why is Zerodha Fund House launching only passive schemes? And third, Zerodha Fund House's strategic plans for expanding its offerings.
Hi Vishal, thank you so much for being here and accepting our invite. It's really an honor to have you on our show and really excited to have this conversation with you.
Thanks so much for this opportunity, Kanan.
No, you're too kind, I would say that. So let's begin. What was the objective of starting Zerodha Fund House? If you can elaborate a little bit on that.
Sure. So I think one of the big reasons why we entered the mutual fund space was we felt that a lot more could be done in terms of penetration. If you look at penetration levels of mutual funds today, there are approximately about 5 to 5.1 crore unique PAN folios in the country, which is, in a sense, you're talking about a 3% penetration at this point of time in a country of about 140 crore or so, right? We felt that we could do a lot more in terms of building simple products and building simple journeys in terms of helping this penetration go to the next level. Therefore we decided that we wanted to enter the mutual fund space with a passive only kind of a fund house. Yeah.
So if I talk about 40 to 45 other AMCs which launch not only I would say, but largely if they focus on active products, active mutual fund schemes, that's where their larger revenue comes from. And Zerodha until now has launched only passive schemes, and as you're saying, your plan is to launch only passive schemes going forward. Why is that? Why is that contrast strategy there that you want to launch only passive products?
Again, it's not a contra strategy, Kanan. It's basically with what objective and what business plan you enter the market with. Our plan is to help penetration, and our strong belief is that penetration will only happen if you simplify the product profile, right?
Okay.
So in terms of simplicity of products, in terms of simplicity of journey, in terms of coming up with cost-effective products, we feel that passive products, fit all the check boxes when you look at them as a product class, right? And therefore, our belief is that passive products are the ones that will help lead deeper penetration, especially in a country like ours, where financial inclusion and financial education is still not so widespread. It's important that we come up with products which people understand. And therefore, when you look at the objective with which we've entered, if you want, say, the next 10 crore people to start adopting mutual funds, you've got to be working on simple products and simple journeys to help that kind of penetration happen. Yeah.
Got it. But passives have already been in the market, and still largely it is driven by EPFO flows of late. The passive AUM as a percentage of total AUM is close to 17% in India, which typically hovers around 30 to 35% in the US. Why do you think there has not been an adoption of passive funds so far, despite them being in the industry for so long? And you launched India's first passive product, right? So why is that?
See, the first thing to understand about passive products, and it's not only to do with India, it's across the world, passive products are bought, they're not sold. And therefore it's an evolution due to which you'll find that across the world, and the number for the US is not 35%, as far as I know it's touched about 50% or so.
Okay.
So nearly half of the assets in US are now passively linked. When you look at the Indian context, I think, yes, I mean, a lot of flows coming in from EPFO, I think since the year 2015 or so, but it's important that you look at the period in context. So if you look at what has happened in the last 4 to 5 years, there's been a huge jump in, in penetration of passive products across index funds and ETFs. Look at the number of folios in ETFs in the year during COVID time in March 2020. I think if I remember correctly, it was something like 18 lakh or something like that, were the total number of users of ETFs. Today it is 1.4 crore in a span of 4 years or so. Look at what's happening in index funds. Index funds, if I remember correctly, the number of investors were about 5 lakh or something like that. The number of folios were about 5 lakh or so. I think it's touching 75 lakh now, right? And this is only in the last 4 years, and I think this is just the beginning. I think people are beginning to realize the benefit of investing in simple, low-cost products, and I think you will see the penetration levels going up far more as we move ahead. I'd also like to go back a little in history and try and explain to your audience in terms of why in the last 4 or 5 years we've seen such a huge spurt in adoption of passive products. There are 2 changes that happened somewhere in 2018. I think one in 2017 and one in 2018. So the first change that happened was that the regulator changed the benchmarking norms in India. Since till about 2018 or so, most schemes, whether active or passive, were benchmarking themselves versus something called as a price index, right? So what you see today on the television is a price index, right? You see the Sensex at 76,000, it's a price index.
Yeah, right.
It doesn't factor into account dividends, right? Now the index which has got dividends in it is called as a total returns index. Any fund should be benchmarking itself versus the total returns index, because when a fund is investing in the underlying securities, it is earning dividend, right? The gap between a price index and the total returns index is typically what you term as a dividend yield, right? And depending on which segment you are in, the dividend yield kind of varies between 1 to 1.5% or so. So Nifty for a long period of time, if I remember correctly, the dividend yield was about 1.2% or so.
Correct.
Now that 1.2% was actually being shown as outperformance, which was never outperformance, it was actually dividends that were being earned by the underlying scheme, right? So that regulation changed and all schemes compulsorily had to benchmark themselves versus the total returns index. The next change that SEBI brought about was the scheme categorization, where prior to the scheme categorization, most schemes in the market would kind of call themselves as large cap schemes but had a decent amount of exposure in mid caps, and that kind of got shown as outperformance if the markets went up, but it was never outperformance, it was additional risk that the fund had taken, right? Now once the scheme categorization kicked in 2018, and a year later when the data started coming out, it became very apparent that most schemes were kind of underperforming their benchmarks, and I think that's when investors kind of started moving towards passive products like ETFs and index funds, and that is what has led to the growth of passive products in the last 4 to 5 years. So that's why I'm saying you need to look at passive products in the context of the period that we're in. It's good to look at how they've grown in the last 4 to 5 years, and then you'll get a better idea in terms of how penetration is happening. Yeah.
So you see, there's a big challenge when it comes to ETFs in terms of price discovery with respect to NAVs. How does Zerodha Fund House tackle this challenge and clear the discrepancies?
So I think we need to look at this in 2 different aspects. One is the fact in terms of how the scheme is being managed. So as I mentioned to you, we're a pure passive fund house, and therefore we ensure that our schemes are tracking the index as closely as possible, and therefore you will see that in terms of even tracking error and things like that, we're as competitive, not better than most of the peers which are there in the market. The second thing is in terms of you have to remember that in ETFs there is a market making ecosystem that all ETFs are kind of dependent on, and that ecosystem is something which is still evolving in India. If you look at internationally, there's a huge market making ecosystem which is there, which helps a lot of price discovery in these ETFs. But in India at this point of time, we have very few market makers in the country. But as we move ahead, there are a number of international market makers as well as a number of new Indian market makers who are getting in, who will kind of help that ecosystem become better. You will also realize that over the last couple of years, year after year, year after year, year after year, the liquidity in ETFs is increasing, right? And it's liquidity that drives liquidity, which drives liquidity and leads to better price discovery. So every year, year after year, the discovery and liquidity in ETFs is getting better. Also, I'd like to mention here that the industry is also working with the regulator in terms of how this market making ecosystem can be strengthened further. So you will see a lot of changes happening in the next 2 to 3 years in terms of this market making ecosystem becoming far more stronger than what it is today, right? So as I mentioned to you, one is in terms of how the AMC is managing its funds, and the second thing is in terms of the ecosystem that is there, the market making ecosystem that is there in the country. So when you look at both these things, as we move ahead, you will find that ETF pricing, market making, liquidity will keep getting better in the coming years.
Sure. So we did one research and designed an all stock index. Like how would it have performed against Nifty 50 and Nifty 500? Like an index of 4,500 stocks or 5,000 stocks. Like we have the Russell 3000 index in the US, and we saw that it far outperformed the Nifty 50 and 500 benchmarks. Right? I won't call them benchmarks, but the respective indices. Why do you think in India we do not have an index fund like a Russell 3000 like there is in the US? And like what are the challenges you face today in terms of regulation, or of course there's price discovery problem in the stocks beyond Nifty 500, there are liquidity challenges, and as an ETF it is difficult to as an ETF or as an index fund, it is very difficult to come as close as to the index. Of course that is there, but how is US able to do that? I'm sure there would also be some liquidity concerns after the 1000 or the 1500 or the 2000 top stocks, right? But how does it happen that they are able to do it and we are not able to do it, right?
So again, Karan, I mean, let's look at it in terms of perspective of the economy, right? You're talking about an economy which is like a $25 trillion economy, $25 trillion economy, versus an economy which we're now at $4 trillion, right? So different, very different, benchmarks to compare with. I don't think we should compare ourselves with the US, because that's a far more, advanced economy than where we are. In India, if you look at the number of companies, I mean, you'll find that there are certain AMCs now who are launching indices or products on the 750 index. So in a sense, it is happening, but you have to look at it from the Indian perspective. So, it's only in the last 4 to 5 years that you'll see that there is decent amount of liquidity happening in the mid caps and small caps also. Micro caps are still is still a segment which is yet to, reach even the small cap stage, right? So when you look at, say, large cap, mid cap, and small cap, approximately about, I would say, 60 to 65,000 crores of volumes is happening in all these three segments, which makes it easier for AMCs to launch products in this kind of a space. The micro cap space is still, very nascent. I would tend to think, but as the economy evolves and as it gets more developed, you'll find more and more segments becoming far more mature than what they are. The second big thing is also in terms of, if you do a pure market cap based index, in terms of what value does, so even when you look at, say, a Nifty 500, right, the small cap segment, adds only maybe about 8 or 9% weightage to the index. So it's small at this point of time. If you look at micro cap, if you look at the 750 stocks, it's only about 2.5-3%. The question then comes is that to add the 2.5-3% kicker by adding a micro cap segment and taking an exposure to 250 more companies at this point of time, does it make sense or not, right? So I would tend to think at this point of time we're still not there as an economy, but in the next 3 to 4 years you will find even the micro cap segment being meaty enough to be able to add enough weight for you to kind of do an index in it. So I think slowly we will get there. Hopefully one day you will see a 1,000 stock index, a 1,500 stock index, but I think it is more linked to you as an economy, number of companies, maturity of all these companies, which I think we are getting there, and hope in the next couple of years we'll be able to launch products on much wider indices. Yeah.
But do you have any plans of launching a micro cap index or a total market index in the coming years?
Not immediately,
Okay.
Kanan, but at some point of time, yes.
Okay,
Yeah.
got it. So Zerodha Fund House offers only direct schemes, which is again not something which other AMCs do. Why is that? And do you have any plans of launching any kind of regular schemes?
So at this point of time, see, as I mentioned to you, we're a digital first, a tech first AMC. So, passive products, direct products, fit into what we're doing. Even if you look at the pedigree that we come from, which is, our promoters, whether it is Zerodha Broking or Small Case Technology Private Limited, I mean, we understand this space very well, right? We understand, building digital platforms, building digital journeys, building financial products, for the ecosystem, and I think we've been quite successful in it, and I think we believe that we can add more value in that space, and that's why we're there, right? Because we believe that that is something that we can contribute more in that space as compared to say a distribution space. The second other thing is obviously that for me to have a regular plan, I need to also create a distribution ecosystem externally, internally, to cater to that crowd, including products. So at this point of time, even you look at the products that we are launching, we're launching passive products which are not generally natural products for, say, a distributor to launch, because of the fact that they're low cost effective products, right? Most distributors would prefer to kind of sell active products where the commission levels are higher, right? And therefore the products at this point of time that we're launching are not very natural products, for a distributor to have on their platform. At some point of time, if we do decide to launch products where we need to use that network to be able to distribute, then yes, we will use that network to be able to distribute. But at this point of time, we think there is still a lot that can be done in the digital ecosystem, in the tech ecosystem, to be able to reach out to more and more people through passive products. Yeah.
Got it. So speaking of technology, like you said that Zerodha Fund House is primarily a technology company as an AMC. So what are the different things that you are doing on the technology front that other AMCs are not doing or have not done so far?
So, there are two aspects to it. One is in terms of what we're doing as an organization to help smoothen flow within the organization, and the second thing is in terms of how we're using technology to be able to reach out to more and more people, right? In terms of using technology within the organization, we're spending a lot of resources in terms of being able to, right from fund management to customer service, we're building an internal backbone inside the organization, right? So right from how a fund manager invests to how customer service is managed by the organization is a software that is a backbone that we're developing within the organization. That's one thing that we're doing. So what will happen is that at some point of time, even at scale, right, we will not need to add too many more people in the organization, because a lot of it will get taken over by the technology that is there in the organization, right? So we're building the organization such that we're able to work at maybe 100 times the scale than what we are at this point of time. And that's where technology will help us within the organization, to help us scale the products and also be cost efficient for the investor. That's the first thing. Second thing is in terms of, what we're doing externally. We're working on various aspects of user flows. At this point of time, maybe we're a couple of months away from launching those user flows, but we're trying to see how we can make it easier for investors to start investing. Right now, one of the things that we have innovated on and which you will see, which will come out in the market in the next couple of months, is the WhatsApp flow. So people will actually be able to invest through a couple of clicks using WhatsApp, right, which nobody in the industry has done. So these are different things that we're trying to experiment on in terms of how we can make it easier for an investor to invest in our products and also come closer to him, come onto platforms which help us come closer to him, right? So that is something that we're using technology to be able to reach out to and create journeys which are much more easier than what they are for an investor today.
So speaking of distribution, mutual funds have been in the Indian investing ecosystem for a while now, and even if we talk about digital journeys, they have also been for around close to 10 years. Still we have a penetration, like you said, of close to 5.1 crore unique PANs as of date, and which is close to 3% of our population. While if we look at smartphone users, they're close to 70 crores. If we look at vehicle owners, the number of vehicles sold in India, they're close to 32 crores. Why are we not able to reach to that level? Of course, if someone can buy a vehicle, then definitely they can invest in mutual funds. That's what I'm assuming, because no vehicle comes at an EMI of less than 5,000, 7,000 rupees, even the two-wheelers, right? Why are we not able to reach there? What challenges do you think we had until now? And do you see this number growing going forward?
So good question, Karan. I mean, I don't know if it's right to maybe compare cars or something like that with investment. The logic that yes, if you're buying a car, you will have money to invest, I completely agree with you, but a lot of these consumer products are also being bought because loans are becoming very easy for people to obtain. But it goes without saying, I mean, what you're saying is completely right in terms of the fact that there is a market out there to cater to. I mean, simple numbers, there are 80 crore guys who are using e-commerce. You said there are 70-80 crore guys who have smartphones. There are 55 crore guys who've linked their PAN with their Aadhaar cards, right? So there is a huge market out there to be tapped, and that is something that we are working on, in the sense that when you look at us, especially, I can speak about us as an AMC. When I first started off talking to you, I said that look, we're going to be a completely retail-focused AMC, right? And therefore, what we're trying to do is that we're trying to build products focusing only on the retail investor. Okay. One of the examples that I could give you in terms of what we've tried to do and how it has helped is India's first growth liquid ETF that we launched, Liquid Case. Now, when you looked at most of the liquid ETFs today in the market, most of them had a constant NAV, right? So NAVs were at 1,000 rupees. Whatever were the underlying investments that were yielding interest were being passed on to the investor, either in the form of additional units or cash in the investor's amount, in the investor's account. Now, for years on end, we had customers coming to us and saying that, look, it's becoming difficult to track the dividends that are being issued out by the AMC. And in a sense, it was pretty user unfriendly for a long period of time, right? When we set up the AMC, and this feedback kept coming to us, we sat and we worked on a product structure which made this liquid ETF much easier, right? And we launched that product in Jan of 24, and within a span of about a year or so, is the second largest ETF in the country, right? It's a growth ETF, so therefore it becomes very easy for investors to track it, because the dividends, that the interest that the scheme is earning is getting reflected in the NAV. It is listed and traded on the stock exchange, and we also brought the ticket size down from 1,000 rupees to 100 rupees.
Okay.
Right. So in a sense, we sachetize the product. Right. Now that has resulted in a lot more investors using the product than what it was before. Right. So to give you, some other stats also, when you look at the trades that are happening on the exchange in something like a liquid case, the average ticket size of the trade is approximately 1 lakh rupees. Whereas if you look at the other ETFs, it's about 5 lakh rupees. Right. So we've already brought the ticket size down by 1/5. Which has resulted in many more investors being able to use the product, right? So one thing is the product innovation. So wherever we can innovate, wherever we, have an idea through which we think will lead to better penetration, we will definitely launch those products that are there in the market. And in other places, we have to figure out in terms of distribution, how we can reach out to more and more people, right? And the third pillar is then education, right? How is it that we can start educating more and more people and getting them to start investing, their investment journeys, right? So these are three pillars that, we are working on as an organization, and you will see changes happening in the coming years. So for example, today also, if you look at the unique PAN folios that are being added in the industry is about 8 to 10 lakh or so, right? Which used to be much smaller if you looked at it 2 or 3 years back. So we're adding about 1 crore new investors as an industry into the ecosystem every year, right? So which itself is a big jump. But if we need to add 50 crore more guys, say in the next 10 years, we're talking about not adding 1 crore, but we need to add 5 crore more people, right? And therefore you need to have more simplified products, you need to have more simplified journeys, you need to be able to come closer to the investor and be able to tap him. And that is all, I would say, work in progress. But we will get there, Kannan, in the next couple of years, I think.
Got it. So speaking of active funds, as per the SPIVA report, on a 3 to 5 year benchmark basis, more than 85% of large cap funds have not been able to beat their benchmark, that is S&P BSE 100, right? Even on a 10-year basis, that's more than 60%. If I talk about small and mid caps, it's slightly lesser, but it's still not, but it still hovers around 40 to 60% for in all of these time periods across small and mid cap schemes. Why is it becoming so difficult for the active fund managers to beat their respective indices?
Karan, I don't think this is anything new. It's just that data wasn't available earlier. Even if you looked at the SPIVA report in 2005, it very clearly showed that most of the active guys were underperforming the index. Right. The only reason why it showed as if they were outperforming because the benchmarking was wrong, the categorization was wrong. Right. Okay. So it's not a question of active outbeating passive. When you look at data at any given point of time, you will find those 5-6 people who are outperforming the index, and you will find a rest of them underperforming the index. The challenge is that the guy who is outperforming the index or is outperforming his benchmark is changing every time. So how do you pick the future winner is the issue, right? And I think that's a bigger challenge. Doesn't matter whether it is a mid-cap segment or a large-cap segment or a small-cap segment. I think the bigger challenge there is to be able to pick the right fund manager, the right scheme, the right sector, the right stock. I think that challenge has always been there and will continue to be there even in the future.
Got it. Who exactly is your target audience at Zerodha Fund House?
So at this point of time, Karan, as I said, the products that we are creating are very democratic products. Our whole objective is that we want to help penetration. Objective is that we want to simplify the investing experience, the journey. With the simplification, you will find a lot more people in different age groups, in different categories, adopting these products. And so therefore, we don't have a specific target audience. Our objective is to help people start investing, achieving their goals, through the financial products that they're investing in, and help basically define a better financial future for themselves.
Got it. So do you have in mind to reach the remotest parts of India and make them invest in mutual funds, which is slightly missing as of date?
Definitely, Kanan. So that obviously is an objective. We're already seeing traction coming. I mean, majority of the investors who are investing in our products are coming from smaller towns. I mean, it is my ambition to help more and more people start investing, and we're still very nascent in our journey. So at this point of time, in terms of where we are, we still launched our first bunch of products. We will see another few products coming into the market in the next 3 to 6 months. We're working, as I said, on various investor journeys which will simplify things. We're working with various partners, whether they're fintech partners or whether they're distribution platforms through which we can reach out to these people in various ways. And you'll see a lot of this unfolding in the next 2 to 3 years. And the objective is to get as many more people to start investing as possible, because as a country, if we're not able to get the next 50-60 crore guys to start investing, I mean, it won't make sense, right?
Right. So how do you plan to simplify the products? Like, within a mutual fund also there are 4 types of schemes, right? There could be growth, there could be IDCW, etc. And then how do you plan to simplify these products beyond, like you said, that your aim is to simplify products, and that's why you're going gung-ho on passives right now, right? So how do you plan on simplifying these products apart from them being passives to the audience? That's point number 1, on educating them through your platform. And second is, how do you plan on leveraging technology to reach to the last mile?
So in terms of simplifying products, if you look at the first product that we launched, the large mid-cap 250 index, we have only one plan, right? So we don't want to clutter, firstly, our product suite. So within a product, we don't want to have 4 or 5 different plans, which then makes it even more difficult for someone to understand. So as I said, when we look at any product that we want to launch, we look at it from the lens of a retail investor and how we can kind of make it easier for him to make a choice. Right, the day you give 4 or 5 different choices to an investor, the choice then becomes in terms of how you're educating him to understand all those choices, right? So therefore, when we decided to launch the first product, we said that we will have one scheme. It'll be a growth scheme, and people can just look at that one product, for their equity needs, right? We don't want to be launching 10 different products and cluttering the, the product suite. So one thing is that we will have, plain vanilla exposures through either an index fund platform or an ETF platform. So it could be, as we've launched, a large cap 100 ETF, a mid cap 150 ETF. So those give you segment exposures in terms of large cap, mid cap. We've got one commodity fund, which is gold. We've got one debt fund, which is the liquid ETF that we have. So through these 4 products, you can actually build a portfolio, a very simple portfolio for yourself with a mix of equity, debt, and commodity. The other things that we want to do as we move ahead will be solutions, ready-made solutions for people, right? And through those solutions, if you don't want to kind of mix and match your portfolio, you want a ready-made solution, then you'll get a ready-made solution through maybe a fund of fund format or any other format that the regulation allows us to do it. So the objective is to be able to give options to people either to build their portfolios or to pick up from a ready-made suit which is there. In a sense, when you walk into a restaurant, you have an a la carte menu and you have a thali. So giving both options to people. So those who want to choose the food that they want to eat, they can choose it. Those who want to have something ready-made can have a ready-made menu of products to invest from. Yeah.
Got it. Since you spoke about thali allocation, I would like to ask you, what could be an efficient asset allocation mix only using ETFs for someone who is investing for their long-term goals, say buying a house 10 years down the line or planning for their retirement? Say for a 30-year-old, if we have to talk about, how should one go about it using only ETFs?
So, I mean, very difficult to give you a number, but what is important in my experience is, the first thing is discipline, is having regular investments, every month that you're making, whether it's through SIPs or lump sum investments that you're making. The second big thing is diversification, right? So investing across equity, debt, commodity is something that you should look at. Your mix would be dependent on your financial needs. So depending on where you are as an investor, your risk-taking ability, your financial needs, is how then you should build a portfolio. The best way for you to build a portfolio is through passive products, right? Because if, let's take a simple example, I wanted, as you're saying, what could be a logical portfolio for, say, a 30-year-old, obviously you would tilt your portfolio more towards equity because you have a longer time period to benefit from the equity returns. It could be something like what they say is that 100 minus age, maybe 70% should be in equity. And within equity, what should you invest in? Maybe you could look at a large cap ETF and a mid cap ETF and a small cap ETF in the 70. The rest 30 could be a mix of commodity, which could be gold or debt, right? All these three asset classes are very easy for you to implement through an ETF or an index fund in that matter. Right. So passive makes it very easy for you to kind of, in just 3 or 4 entries in your demat account, have a good meaningful portfolio.
Got it. Like, apart from the challenges you highlighted which were there until 2017 and 18 because of the tracking problem, we did not have a TRI and now we have that. But apart from that, what all challenges do you face in running a passives only AMC, or even for that matter, you have been in this space for more than 20 years now, launching the first ETF, right? What are the challenges of passive fund management in India, launching passive schemes? Where do you see passive investments sector going forward in India in the next 10 years?
So again, in terms of managing passive schemes, I don't think there is too much of challenge in the market. As I mentioned to you earlier, one of the things that the industry together is working on is to build a far stronger market making ecosystem. So that is one challenge that the industry together is working on, and you will see changes happening in the next 1 to 2 years, hopefully in that ecosystem, which will make price discovery and liquidity in ETFs much better. The second thing is obviously in terms of having the resources to be able to in a sense market or make passive products more visible. I think that is something that may be a challenge, because even if you look at the larger guys in the market today, a lot of their passive businesses are getting subsidized by the active business that they have, and therefore the amount of money that is getting allocated towards marketing and increasing visibility of passive products is still very limited, right? Until you don't have a lot of these, a larger amount of money being spent in promoting passive products, you will find traction happening in that sense slowly as compared to if you had that money being spent. So one thing is obviously the money that is being spent in terms of creating visibility. As we move ahead, I mean, as that will keep increasing, you'll find more and more education about passive products happening. So I think that is more to do with in terms of how we take visibility now, say 10x from here. So it has to be a mix of everything, right from advertising to education to being able to create the right market making ecosystem, so that customers get the right experience when they're investing in an ETF and an index fund for that matter.
Got it. So pursuant to a recent SEBI circular, passive hybrid has been added as a index, right? Passive hybrid has been added as an index. How do you look at it, and do you plan on launching any index around that anytime soon?
No, definitely, Kanan. I mean, we think it's it's a very interesting space, and we will have products in that space. So hybrid was earlier what you termed as balanced funds, which are now being called as hybrids. So that category has always been big. I mean, even if you look at data today, about 5 to 6 lakh crore of AUM is being managed in that space, and therefore having a hybrid passive will give investors an ability to invest in a hybrid scheme which is passive and is low cost in that sense, right? So they have an ability to be able to invest in a far cheaper scheme than what they could on the active side. So I think it's fantastic for investors.
And you plan on launching any?
Definitely.
Great. So talking of your first scheme that you launched, that was large mid cap 250 index fund. Why that particularly and not any other index fund?
Because as I mentioned to you, I mean, one of the objectives that we have is to declutter the product suite. So we don't want to have, you know, just too many products in our product suite. And therefore, when we were at the drawing board, we were trying to figure out at that point of time in terms of what is that one product which somebody could keep investing in forever, right? And after a lot of research and work, we realized that this 50-50 mix of large and mid cap kind of suited, you know, the kind of product that we were looking for, which investors could kind of invest in. It was a sweet spot in terms of stability that you're getting from large caps and that small growth kicker that you'll get from mid caps as you move ahead. So that combination, in a sense, was good in terms of having the top 250 companies. So if somebody looked at it, he's investing in the best companies that are there in India, also getting a bit of kicker because there is a slight more weightage in terms of the mid cap allocation that is there.
Got it. And speaking of, you know, wealth management space evolving in India, how have you seen in your experience of 2.5 decades this space growing in terms of not just retail but HNIs and institutional investors as well?
Again, I think it's evolved a lot. I mean, when I look at the industry, maybe about 2 decades back, I mean, you found maybe just a handful of 3 or 4 guys doing wealth management. I think now there are hundreds of them who are doing it. Obviously, in terms of choices that investors have, it's become much more. In terms of ability to give advice to investors, it's increased far more in terms of what advice they're giving. Segmentation is also happening in terms of you'll find certain outfits which are only catering to, say, ultra high net, ultra HNIs. Others are catering to HNIs. You have the banking system which is kind of catering to a slightly lower segment, you know, clients who are of the banks. And now you have a lot of, you know, in a sense, digital platforms which are robo-advisors, right? Where you're able to, you know, go through those platforms and invest even small amounts. So you're able to build a kind of portfolio, you know, through these wealth platforms at a very low cost, right? And then the other angle is the various products that you have today in the mutual fund suite, right? Which is allowing people to kind of build or invest in products and be able to kind of build their financial journey. So I think it's become very holistic now. People have a lot of choice, and I think it'll just keep getting better, you know, as we move ahead.
We have very few RIAs in the country as opposed to insurance distributors or mutual fund distributors, right? There are not even 1/100th of them. Do you think, like, typically in India, financial advice is being doled out by distributors or people who are making a kickback, in a sense, by selling a financial products? How important do you feel is the role of RIA, SEBI-registered investment advisors, to advise the Indian consumers?
See, I think India is at a stage, Kanan, where we should do all we can to reach out to investors. So whether he's a mutual fund distributor, whether he's an RIA, whether it's distribution, whether it's direct and digital distribution that is led by AMCs like us, I mean, I think we all need to be there and contribute in terms of reaching out to more and more people, because I think we should keep that target in mind. I mean, we should try and figure out how we can reach, you know, 50 crore, 60 crore people, and I think that's very important. In terms of your question, in terms of which mode is right, I mean, I would tend to think definitely an RIA mode is the way for us to go in the future, simply because of the fact that it aligns the distributor's interests with that of the client. So definitely that is an ecosystem which is something that you know, will evolve as we go ahead, and I think should be the future for a country like ours.
Got it. So that's all from our side. Thank you so much for sparing out your time, and it means a lot to us.
Thanks a lot, Kanan. Thanks for inviting me.
The key takeaway for us from this conversation is that Zerodha Fund House is focusing on building simpler products for the larger user base, and their target is to penetrate a larger number of people in the mutual fund industry as opposed to just 3% today. So if you like this conversation, do hit like and subscribe and share this video with your friends. Thank you.